There was a moment in European history when the entire economy began to run out of money. Not metaphorically, not because of bad policy or reckless speculation, but because the metal itself, the silver that backed nearly every coin in circulation, began to disappear. Mines slowed. Trade drained bullion eastward. Disease shattered labor markets. And a continent built on metallic money found itself facing a simple, terrifying constraint. No silver, no currency. No currency, no commerce. Power and history collide, and nothing is ever as simple as it looks. To understand the crisis, you have to understand the system it threatened. After the fall of the Western Roman Empire in the 5th century, gold coinage largely vanished from everyday use in Western Europe. The sophisticated monetary networks of Rome fractured. For centuries, economic life contracted into local exchange. By the 10th and 11th centuries, however, Europe began to recover. Population grew, agriculture improved, trade routes reopened, markets expanded. And with that expansion came a renewed need for money. But Europe did not rebuild on gold, it rebuilt on silver. From roughly the 10th through the 13th centuries, silver coinage formed the backbone of the European monetary system. Kings and local rulers minted pennies, deniers, pfennigs, small silver coins stamped with authority. These coins were not abstract promises. Their value was tied directly to their metal content. A coin was money because it contained silver. No silver, no value. This meant that the money supply was constrained by geology. Silver came from mines, and medieval Europe had several important ones. The Harz Mountains in what is now Germany produced significant quantities. Bohemia, particularly around Kutna-Hora in the late 13th century, became one of the richest silver-producing regions in Europe. Smaller deposits existed in France, England, and the Iberian Peninsula. When mines produced well, coinage expanded. When output slowed, liquidity tightened. There were no central banks to adjust supply, no fiat currency to issue in response to crisis, no quantitative easing to stabilize credit markets. The volume of money circulating through European markets depended on how much metal could be dug out of the earth. For a time, this system worked. The 12th and 13th centuries saw commercial revival. Trade fairs in Champagne connected northern and southern Europe. Italian city-states like Venice, Genoa, and Florence expanded Mediterranean commerce. Merchants carried silver coins across borders. Feudal dues were increasingly paid in money rather than in kind. Tax systems began to depend on reliable coinage. Silver was not just a medium of exchange. It was the bloodstream of the economy. But even during this expansion, cracks were forming. Europe did not exist in isolation. It traded with the Byzantine Empire, with the Islamic world, and increasingly with Asia. Spices, silk, and luxury goods flowed westward. Payment flowed eastward, often in silver. Over time, significant quantities of European bullion left the continent through trade imbalances. Silver drifted toward regions with strong demand, particularly into the Middle East and beyond. Meanwhile, mining productivity was not infinite. Medieval mining techniques were labor-intensive and technologically limited. As easily accessible deposits were exhausted, extraction became more difficult and costly. Output slowed. When the flow of new silver decelerated, the money supply tightened. By the early 14th century, Europe was facing a mounting monetary pressure. Then came catastrophe. In 1347, ships arriving in Sicily carried a plague that would sweep across Europe. The Black Death, caused by the bacterium Yersinia pestis, killed an estimated 30 to 50% of Europe's population within a few years. Entire villages vanished. Urban centers were decimated. Labor markets collapsed. Agricultural production plummeted. Mining did not escape this devastation. Silver extraction required skilled labor. With population reduced and social systems strained, mining operations faltered. Less silver was produced precisely when economic disruption demanded flexibility. What followed was not immediate inflation, it was contraction. With fewer people, demand for goods fell in many regions. Prices dropped. Wages fluctuated unpredictably. Tax revenues declined as population shrank and economic activity stalled. Rulers who depended on silver coinage to collect rents and finance military campaigns faced fiscal shortfalls. In a metallic monetary system, contraction is ruthless. If coins vanish from circulation and new metal cannot replace them, trade seizes up. Credit becomes harder to extend. Debts become heavier in real terms. Deflation increases the burden on borrowers. A system built on physical scarcity offers no easy release valve. Medieval rulers understood the danger. Armies still needed funding. Courts still required maintenance. Political authority depended on visible power. And power required money. They could not mine silver fast enough, so they turned to the coins themselves. Coin debasement was not new. Even Roman emperors had reduced the precious metal content of currency to stretch supply. But in the late 13th and early 14th centuries, debasement became a strategic tool across parts of Europe. One of the most notorious examples was Philip IV of France. known as Philip the Fair, who ruled from 1285 to 1314. Facing expensive wars and chronic fiscal stress, Philip repeatedly altered the silver content of French coinage. He ordered remintings, reducing the amount of precious metal in each coin while maintaining face value. The crown collected old coins, melted them down, and struck new ones with less silver per unit, pocketing the difference. On paper, the nominal money supply expanded. In practice, trust eroded. Prices adjusted upward as merchants demanded compensation for reduced silver content. Savers found that their holdings lost purchasing power. Wage earners struggled as the value of coin fluctuated unpredictably. Inflation, primitive but real, emerged from metal manipulation. When money is metal, governments still find a way to print it. Philip's policies triggered public unrest and economic confusion. But he was not alone. Other rulers across Europe engaged in similar practices as they grappled with constrained bullion supplies and fiscal pressure. Debasement became a short-term solution to long-term scarcity. The consequences were uneven. Rulers benefited from seigniorage, the profit made from minting coins with lower metal content. Debtors could sometimes repay obligations with lighter currency, but creditors and wage earners bore the cost. Monetary instability introduced volatility into markets already shaken by demographic collapse. The old system was straining, but it did not shatter. It adapted. When silver became scarce and coinage unstable, Europe did something that would permanently alter economic history. It began separating money from metal. The shift did not begin in royal courts. It began in merchant houses. In the 14th century, Italian city-states such as Florence, Venice, and Genoa were at the center of European trade. Their merchants operated across vast distances, from London to Constantinople. Moving physical silver across that network was inefficient and dangerous. Scarcity only made the problem worse, so they refined an innovation that had earlier roots but now became indispensable: the bill of exchange. A bill of exchange allowed a merchant in one city to deposit funds with a banker and receive a written instrument payable in another city. Instead of transporting coin, he transported paper. Settlement occurred through networks of trust between banking houses. It was a quiet revolution. Money was no longer just metal. It was a claim. This abstraction required credibility. Banking families, such as the Bardi and Peruzzi of Florence, expanded their operations across Europe. They extended credit to monarchs, financed trade, and facilitated cross-border payments. Double-entry bookkeeping, formalized in the 14th century and later codified by Luca Pacioli in 1494, allowed merchants to track complex financial flows with precision. The system grew sophisticated and risky. The Bardi and Peruzzi banks extended massive loans to Edward III of England in the 1330s to finance the early stages of what would become the 100 Years' War. When Edward defaulted in 1340, both banking houses collapsed. The shock rippled through Florence. Credit contracted sharply. Wealth evaporated. Financial innovation had reduced dependence on silver, but it had introduced counterparty risk. Scarcity had forced abstraction. Abstraction had created fragility. Meanwhile, Europe experimented with reintroducing gold into circulation. In 1252, Florence minted the gold florin. In 1284, Venice introduced the gold ducat. These high-purity coins were designed primarily for international trade, where larger transactions required stable units of account. Gold, rarer and more compact in value than silver, provided an alternative anchor. Diversification was born from necessity. By the 15th century, Europe operated with a more complex monetary ecosystem. Silver coins still circulated locally. Gold coins facilitated large-scale trade. Credit instruments lubricated long-distance commerce. Banking networks mediated flows. Power began to shift. Under feudal systems, wealth was tied primarily to land. Lords extracted rents in kind or coin. Political authority rested on control of territory and agricultural output. But as money became more abstract and trade expanded, urban commercial elites gained influence. Banking families financed monarchs. Merchant guilds shaped policy in city-states. Capital, not acreage, increasingly determined leverage. When the Medici rose to prominence in Florence in the 15th century, it was not through conquest. It was through finance. Monetary stress had accelerated political evolution, and yet instability remained. The 14th and 15th centuries were punctuated by recurring crises. Currency debasements continued intermittently across Europe as rulers sought fiscal relief. Trade disruptions triggered liquidity squeezes. Wars strained budgets. Inflation and deflation alternated unpredictably depending on metal supply and political manipulation. The lesson was becoming clear. Money was not fixed. It was managed. Then, in the late 15th and early 16th centuries, another transformation arrived, this time from outside Europe. In 1492, Christopher Columbus reached the Americas. Over the next century, Spain extracted enormous quantities of silver from New World mines, particularly from Potosí in modern-day Bolivia and Zacatecas in Mexico. Between the 1500s and early 1600s, tens of thousands of tons of silver flowed into Europe. The scarcity that had constrained medieval economies flipped into abundance. The result was the price revolution of the 16th century. Prices across Europe rose dramatically, in some regions quadrupling over the century. Inflation accelerated as the influx of silver expanded the money supply. Those who held fixed incomes suffered. Debtors benefited. Governments saw nominal revenues rise, though purchasing power fluctuated. If there were a gold medal for unintended consequences, Spanish silver would deserve a podium finish. The monetary crisis of the 14th century had been deflationary, contraction driven by scarcity. The 16th century faced the opposite dynamic, expansion driven by abundance. Both episodes revealed the same structural truth. Metal does not guarantee stability. When supply shrinks, systems contract painfully. When supply surges, purchasing power erodes. The belief that precious metal automatically anchors value ignores how supply shocks ripple through prices and incentives. The medieval silver shortage forced Europe to innovate. The New World silver flood forced it to adjust again. Money kept mutating. Fast forward several centuries, and the physical constraints that once defined monetary systems gradually dissolved. The gold standard in the 19th and early 20th centuries attempted to anchor currencies to metal once more. But even then, banking systems layered credit atop gold reserves, multiplying claims beyond the underlying metal. In 1971, the United States formally ended the convertibility of the dollar into gold. The modern fiat era began in full. Money was no longer tied to metal. It was tied to trust in institutions. And trust, unlike silver, is intangible. The medieval crisis teaches something profound about our current financial system. Back then, Europe faced a liquidity crisis because silver mines could not produce enough supply. Trade imbalances drained bullion. Demographic collapse reduced output. Monetary contraction froze commerce. In 2008, the global financial crisis revealed a different kind of liquidity freeze. It wasn't metal scarcity, it was credit distrust. Interbank lending seized up. Financial institutions doubted each other's solvency. Markets stalled. Central banks responded by injecting liquidity on an unprecedented scale. Quantitative easing expanded balance sheets. Interest rates were slashed. Digital reserves replaced mined silver as the mechanism of supply. Different tools, same pressure. When money tightens, economies strain. When money expands rapidly, inflation emerges. The 14th century had no central bank to stabilize liquidity. Today, policymakers actively manage money supply. But management does not eliminate risk. It redistributes it. The Black Death cut Europe's population by as much as half, collapsing output and disrupting supply chains. The COVID-19 pandemic in 2020 disrupted global trade networks and prompted massive fiscal and monetary stimulus. Trillions of dollars entered the system. Inflation followed in many economies. Scarcity and expansion remain two sides of the same coin. Medieval Europe's silver shortage reminds us that money is not static. It is adaptive. Systems evolve under pressure. Bills of exchange replaced bullion transport. Banking networks replaced feudal dues. Gold diversified silver. Later, paper replaced gold. Today, digital entries replace paper. Every transition reshapes power. Those who controlled silver mines once held leverage. Then bankers who controlled credit flows gained influence. Later, central banks and financial institutions became the architects of liquidity. Monetary stress always redistributes advantage. This is where financial education becomes more than academic curiosity. Understanding economic history reveals how fragile monetary arrangements can be. It reveals how quickly scarcity can trigger innovation, and how innovation introduces new vulnerabilities. The medieval silver crisis did not destroy Europe. It accelerated its transformation. Feudal rigidity gave way to commercial dynamism. Banking families rose. Trade expanded. Accounting evolved. But the process was not smooth. Bank failures wiped out fortunes. Currency debasement eroded trust. Inflation punished the unwary. There is a temptation to romanticize metal-backed money as inherently stable. Medieval Europe disproves that illusion. Silver scarcity caused deflation and paralysis. Later, abundance caused inflation. Stability required more than metal. It required institutions, trust, and adaptive systems. And institutions are human, which means they are imperfect. The central lesson is not that silver failed. It's that no monetary system is immune to stress. Constraints force mutation. Mutation reshapes incentives. Incentives shift power. Money changes form. Power follows the change. In the 14th century, those who understood credit instruments thrived. Those who clung solely to land-based wealth struggled. In the 16th century, those positioned to benefit from inflation gained ground. Those with fixed incomes paid the price. Today, understanding how central banks expand or contract liquidity, how inflation redistributes purchasing power, and how financial systems adapt to crisis is not optional if you care about real wealth or financial freedom. History does not repeat in identical detail, but it rhymes in structure. When the money supply tightens, fear spreads. When it expands too quickly, confidence erodes. In both cases, those who understand the mechanics position themselves differently. Medieval Europe ran out of silver. It responded by inventing new money. We are not running out of silver today, but we are constantly redefining what money is: digital currencies, central bank digital currencies, expanding balance sheets, shifting reserve dynamics. The medium evolves, the stakes remain. If you assume the system is fixed, you become its victim. If you understand that money is negotiated, managed, and constantly mutating, you gain perspective. History doesn't repeat, but if you don't understand how money adapts under pressure, it will reshape your world anyway. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.